and welcome to Money Control. Well, it's a very happy morning this morning. Last 1 week, we've been waiting for the all-time high and finally it is here. Of course, the markets come off a bit from there. Nevertheless, a record high is a record high, and technically there is no resistance from this point onwards. It's a limitless sky. Where do we head? What is the next stop? To discuss all of that, I have with me Anand Shah from Prudential ICICI. He leads the AIF PMS funds for Prudential ICICI. Anand, thank you so much for joining me this morning.
Hi, very good morning. Thank you for having me. It will be a pleasure to interact with your viewers.
Sure. Anand, you've brought in a lot of cheer and good luck to markets this morning. Tell me, what's your sense? Where do we head from here? What is the next stop?
I think, look, first and foremost, not looking at only today, but otherwise, the market's been rallying against many obstacles. It's rallying against many macro challenges. So obviously, it's very surprising that the Indian markets are touching new high, and all the global and the local, macroeconomists and others that we discuss with, they find that India's story is good, but there are many challenges outside. I think the one big underlying factor which is very, very different and it's significant is the earnings growth rate. You see, whether it is large caps, whether it is mid caps, whether it is small caps, the last 3 years have been phenomenal in terms of earnings growth rate, and that comes in the backdrop of the 5 years before that, when we practically had negligible earnings growth rate at the aggregate level. So that's the key difference in these markets versus the previous bull markets that I've seen, that it is climbing the wall of worry to the extent that last 24 months, if you see, last 8 quarters, the earnings would have practically doubled, and the market is up by say 15 to 20%, which means that the PE multiples of market have actually corrected significantly while the market is touching new highs. To that extent, this is a very, very healthy markets. These are very healthy rally where there's no sort of over enthusiasm or euphoria, if you ask me, at a broader level. Obviously, there would be some sort of euphoria and some sort of over enthusiasm in pockets of the market, but at the aggregate level, I don't see it.
Sure. So, Anand, this whole earnings story that you're talking about, how do you look at the character of this earnings bounce back itself? Is it something that is like a rebound from the previous years, especially you had 2 years of lower growth, cut in activities, so many other things? Is this a reflection of some kind of an ongoing rebound, or do you think this is something that we are building on into the future? Is this part of the structural rise that we have been talking about all this while, I mean for many years now?
Indeed, I think to be noted, it's not a rebound of last 2 years. You have to go back into the history and see what happened between say 2015 and 2020. Almost, I can speak for Nifty. Nifty had a 2% CAGR in earnings growth rate, which is rare in 22 years that I've been in the markets. Nifty not growing earnings for a few years when the nominal GDP growth rate in India worst case has been 10 to 11%. And you have to see the genesis of that. So you had an asset quality review in June 2015. Then you had a demonetization, GST implementation, you had an NBFC crisis, then you had a real estate correction leading to a slowdown in the economy in 2019. All that micro challenges on the backdrop that the macro was good, inflation was benign, globally markets were stable. We had many India-specific challenges which led to Nifty at the aggregate level not delivering earnings. The key difference this time around, and more so in last 3 years, including the difficult year of the COVID wave 1, which is 2020, I think the earnings growth rate is there, but not only it's there, it's very broad-based. If you see prior to 2020, you had a specific businesses which were catering to the consumer. The consumer-facing businesses, as I tell you, were doing well, but the manufacturing allied, anybody to do with B2B businesses were struggling. In last 3 years, what we are seeing in the midst of the macro challenges of COVID wave 1, COVID wave 2, and more recently high inflation on the back of Russia-Ukraine crisis, we have a very broad-based earnings growth rate. Both the B2C businesses and the B2B businesses are coming back strongly. More importantly, the B2B businesses are a big driver of earnings growth rate in the last 2 years versus B2C, which were the key driver of earnings growth rate prior to 20. So I think if I were to summarize for the earnings growth rate, I think it's fairly broad-based. Actually, if you go down the market cap curve, the mid caps and small caps are actually growing much faster in terms of earnings growth rate than the large caps. So it's a fairly broad-based across sectors, across market caps, and that gives me a lot of comfort that there's something happening at the individual country level, sector level, and the company levels, which is supporting this strong earnings growth.
Yeah, so that exactly is my next question. So what is that underlying change that is really powering this broad-based earnings rally? Because largely if we look at the Nifty earnings, then usually it tends to be dominated sheerly because of the weightage in the Nifty. You have 40% weightage from banks and you have a substantial presence of commodities. So these two pretty much colored the Nifty. But if you're saying there is a broader participation in terms of earnings, what are the underlying forces or shifts that we are experiencing that is causing this change?
I think the one big force which we all know and aware of, which is the Indian demographics, which is helping the B2C businesses, helping the consumer-facing businesses through the last 2 decades. So that is not new. I think what is changing more recently, and it's new, to give you a little bit perspective, we have to go back into the history for almost a decade and a half. China was a factory for the world. Anything and everything, from safety pin to boiler, from tires to tiles, whatever you want, China can produce it for you and produce it cheap. And to that extent, you post 2008, we had a very difficult period for manufacturers in general, and even lenders to manufacturers. So the corporate banks also suffered, and more so post 2015. If you see, the big drag on the earnings on Nifty was by the corporate banks. That is changing. So corporate banks have provided for most of the manufacturing and infra and PS, and they are now actually benefiting from the recoveries from that. Similarly, many of manufacturing industries which could not survive the downturn either have closed or they have been sold to the surviving businesses. So we have seen a lot of consolidation also in the industry like steel, cement, to some extent aviation more recently we are seeing, in telecom we are seeing. So these are the sectors which drag the earnings, manufacturing allied businesses, including utilities and logistics and others. But they also dragged the earnings of a very large part of the banking industry, which is corporate banks. Both of that is driving the earnings growth rate. So you're right when you're saying that Nifty, the big driver has been banks. But even within banks, if you see, the corporate book of the bank is driving the profitability. Well, retail has been great in the past. It continues to remain good. But the big swing in the banking profitability, which is driving the big EPS upgrades on the Nifty also, is been driven by the corporate end of the bank book. Similarly, commodities, similarly, manufacturing. In small and mid caps, what we are seeing is the second level benefits coming. So we are seeing early signs of, so while the government capex is helping in general, the early signs of private sector capex, higher utilization in manufacturing in general, and the ancillary businesses to the large manufacturing like industrial products, engineering goods, auto ancillaries, and others. And more recently, we are seeing that helping the capex cycle also, which is helping the capital goods segment of the market. So on the mid and small cap, we have more ancillary businesses which are also driving the growth in the earnings in general.
Sure. And do you think the momentum in the real economy itself will continue? Because nobody expected the GDP growth the way it turned out the last quarter, and immediately after that, a number of economists have actually upgraded the expectations for the current year. Do you believe? And there is, of course, there was a report yesterday also that next 3 years we will continue to be the fastest growing economy in the world, large economy in the world. In the face of economic slowdown in the West, do you think we will still be able to sustain the growth momentum?
I think, look, today a lot of stars are aligned. Let me put it this way. I think the big drivers for the economy always and will be the housing sector. I think we still see the housing sector continue to sustain over and above the Housing for All program that the central government leads, the government-led Housing for All program. So I think that's a big driver on the retail side. Governments, both central and state governments, capex cycle is continues to remain strong, both on the urban infra as well as providing infrastructure, social and the physical infrastructure to the masses. I think that's also very strong. I think something which is still yet to kick-start, which is manufacturing exports, which was very strong in 22, was a little bit soft in 23, given what you said, that the Western economy was destocking last year. There is a general slowdown, higher interest rates in Western world is slowing down their consumption. To that extent, there was some slowdown in the manufactured exports, and that also is not yet helping the private sector. I think these are the two missing links as far as India's story is concerned. That when do we see India benefiting from, say, China plus one, India benefiting from overall global economic recovery back, obviously China opening up, some stability in the energy prices in Europe, and obviously the US recovery. So once that picks up, our take is there is a right assumption that the private sector capex is also around the corner. And when that happens, and then there will be job creation, we should have a virtuous cycle of the consumption growth leading to more capex and that leading to more jobs and so on. So, yeah.
So how far away do you think we are from that point?
No, I'm saying we are already benefiting. As you rightly said that the GDP numbers are great. So I think we are there. We are already there.
But I meant the private sector capex.
Yeah, so private sector capex is again, it's not that it's completely dead. It's starting. Yeah. Cash flows of private sector are very, very strong. They have deleveraged also extremely well. And to that extent, both the banking system, the private sector capex balance sheet, both can support a capex. It's a matter of time when the utilizations goes up and you're forced to do new capex for the incremental growth, and which is a combination of both domestic demand recovery. We have also heard of rural economy not yet up to the mark. You also initially we spoke about a little bit of a K-shaped recovery in the economy, and to that extent, consumption has not picked up fully in India also. So Indian consumption recovery, global demand recovery, both in the US and Europe, this should support the higher utilization and that leading to a private sector capex. We are seeing already in the pockets. So among the many MNC manufacturing companies, we are seeing early signs of capex being announced and implemented, as they can immediately move some of their capacities from China or Europe into India. So that's what they are doing. They have an existing market demand which they can fulfill from India. So it's an easy decision for them. For the other private sector companies, they will have to get more confirmation of the global stability recovery and the domestic demand recovery. They have had a very, very difficult decade where they had to deal with banks and they had to deal with the inability to repay loans and so on and so forth. it was a tough time. So the scars are not going to go away overnight. So it's a slow and steady, but it's around the corner, is what I would say.
Sure. Now, Anand, on the strategy side, if we were to suppose, and I suppose all of us believe in this structural story for India, if we were to assume that there is this long runway of growth ahead of us, what should typically be your strategy? Would you buy sizable bets in companies that will have a bright future? For example, we are talking about this manufacturing resurgence today, or pockets where you see there could be very high level of compounding. Pick those stocks and stay with them for a long time. Or do you think markets are now, there is so much information flow, there is so much research, and there's so many fund managers competing for and individual investors competing to look at these stocks, they quickly tend to get overpriced. So do you periodically take money off the table, or can you still go with the good old strategy of picking up good companies, staying with them for a long time and expecting good compounding over time?
Indeed. So I think there's no one answer. I agree. We will have different scenarios for different companies, but I think macros are supportive, but that's just the beginning for us. For us, we are very strong believer that in the end, it is companies that create wealth and not markets. We will be, very, very focused on identifying businesses within this economy, within these sectors where they have a very, very strong moat, a very, very strong right to win, because that's very important when things are not going in your way. Invariably, in a very good times also, we will have difficult phases in the economy, and the company should be able to survive that difficult phase in order to benefit from a longer term structural growth story that this market provides. So I think very, very important. I completely agree with you that there are pockets of overvaluation. There are pockets of even in some areas there would be bubble also. So it's very, very important that the portfolio is built after thorough research, and every company that we buy goes through 3 to 4 layers of filtration. At least 3 to 4 people are involved in every stock that we own in our portfolio. So I think market is not as easy as it was in March 2020 or June 2020, when you had a significant advantage of lower valuations and a lot of pessimism. Today, while the valuations are not very rich, they're not very cheap also, they're somewhere in between. There are pockets of the market where there is expectation very high, running very high. One need to be very careful. Once we build a portfolio, we don't leave it there. We continue to evaluate it. Every quarter is an opportunity when the results and the subsequent management interactions would give us, a time to reevaluate that businesses. Generally, if the stock prices remains attractive, given that while the prices are moving up, the earnings are also moving up, as I said before. So I think markets for our portfolio still remains fairly comfortable in terms of valuation. That's how we see. We are still holding on to our portfolio as we speak.
Sure. Again, 2 questions. One is, if you can just size up the market for us. You said there are pockets of bubble, there are pockets where there are opportunities. So when you just look at the market as a whole, where do you see those bubbles and where do you see those pockets of undervaluation? That's question number 1. And second, when you approach a stock today, how do you approach it? Do you have a time horizon in mind in terms of, how long you would like to hold it? Or is there a stock price expectation that you have? What is your strategy around when you buy every stock?
Yeah, I think let me give you the second question first, and then we'll come down to what sort of bubbles we see in the markets. I think every business that we own needs to have growth. very clearly, we are growth investors. We are always looking for pockets of the economy, the sectors which will grow faster than the economy. And then within that pockets, we are looking for companies which are growing faster than sector. So yes, the growth is a very important element of our stock picking. The second being, as I said, moat, sustainable competitive advantage, very, very important to survive the cycles in the market. And last but not the least is consolidation in the industry. I think that's a big driver of wealth creation, as the fragmentation can be a big driver of wealth destruction. We have seen that in telecom industry, as the number of players increases, the profitability falls. And as the number of players are reducing in that sector, we will see resurgence of profitability and improvement in return on equities in those businesses. So the consolidation also drives not only profitability of that sector, but also superior return on equity, return on capital employed in that sector. So these are the three very important parameters we look at, apart from 97 other parameters that we look at. Second, once we like the business, then we go to management and we're looking for both competence and corporate governance. And once we like business and management is when we go to valuations. Again, the need is not to be the cheapest. We understand the good business and good management would not come cheap. And to that extent, we are ready to pay a reasonable premium for good businesses run by good management. So I think that's a broad philosophy under which the entire team works. As I said, every stock that we buy is analyzed by 2 to 3 our sector specialists, the analysts, or fund managers before it becomes a part of it.
Sure, Anand, my question was more with respect to price. And I'm asking this only because this is a trend that is emerging, that, stocks are, you have buoyancy in a certain sector. For example, you see infrastructure sector or rails or roads. Quickly, you see stocks getting outpriced very quickly, 10% today, 20% tomorrow, and in 2 weeks time in a mid cap stock you could easily see a 50% appreciation. And especially for people like you who'd want to buy sizable stakes, the impact cost is also higher, and once the word is out, then the retail investors also tend to latch on to the stock. I'm saying, in this sort of a market, is your strategy in terms of when do you go again to the table and take some money off the table, or just let the stock prices run and keep compounding? So just with respect to price, what's your strategy?
Indeed. So I think that's a continuous journey. As I said, we would, while we're ready to pay some premium, we'll not be ready to pay unlimited premium for good businesses. Obviously, we'll keep on looking out for. So we have army of people. We have 21-member research analyst team, which keeps on looking for newer ideas. At the same time, in the existing portfolio, as I said, there is a regular review. If there are certain stocks which have become fairly overpriced, then we also exit those businesses. So it has to be dynamic. If I were to say, look, it's great to have businesses which can hold on for many years, but in between, we will have to be actively managing. That is what is the job of an active fund manager. We do take those both buy and sell decisions as required. And unfortunately, today, it has to be more dynamic. As I rightly said, either you get good news or good price. Unfortunately, when the news is very good, you might not get good price. So we'll have to be patient with that. We are continuously looking out for good businesses and waiting on the wings when the valuations are not fair. So we are in no hurry. We can wait also for the market corrections. So that's what I would say.
So normally, your holding period in your portfolio will be about 1 year, or is it less or more?
It would be much more. So we would have stocks being part of the portfolio for anything between 2 years to 4 years also.
Okay.
But it's not a given. As I said, some of the stocks or some of the companies gets re-rated too soon. We will have to churn it out far sooner than later. But generally, the companies in the portfolio will stay for a far longer period.
And has that changed considerably from the time you started, let's say, 10 years ago, 20 years ago? Was that number any different, or?
So invariably, even in 2020, 2021 was a good time where things were not moving as rapidly. So yes, last 6 months have been a little tough in terms of building a fresh portfolio, but nevertheless, that also is an opportunity to go out and meet more businesses, evaluate more, and obviously the IPOs are coming through. We are able to find fairly good new businesses as well as some of the businesses which are listed for a while but were not in the radar of the investor community. So I think it's a mixed bag. I would not be too pessimistic that nothing is worth buying today. As I said very early that there is pocket of the market where we are still able to find a lot of value,
Sure.
given the prospects that exist in those areas.
Yeah. So the bubble territory and the alpha territory.
Yeah, I think the bubble territory again. I would say we are in a far better shape than where we were beginning of this market. So if you see the early bubble territory was quality at any price. I think that's sort of corrected, reasonable. I would not say it has reached a point where it is sort of bottomed out, but at least that entire thinking that you can buy quality stock at any price. I think that sort of investment style has been sort of at a receiving end for last 2 years, and that's something where they're good quality businesses. They deserve to be part of the portfolio, but at a price, and they're reaching at a certain level. We've been sort of avoiding consumer-facing businesses, or for that matter, IT services for last 18, 24 months, and that's worked very well for us. The other one was the innovators slash tech companies. Again, there early on the expectations were very, very high. While they are a new age businesses, and to that extent they bring new services or new product on the table, I think the expectations of the markets and the growth projections for decades to come was something which was misplaced. I think we have seen correction in that segment also, and that's also very healthy in the sense that those businesses are also coming around and saying, look, we also have to make money. So because we were reached a point where they were not supposed to make money and still supposed to get a lot of valuations. So I think to that extent, there has been some semblance in that part of the markets also. To that extent, with this, last 18, 24 months, we have seen a lot of correction. At the same time, a lot of, some sort of a re-rating for the old economy businesses which were sort of struggling under the regime when China was exporting deflation. Now, as China exports inflation, the manufacturing related businesses which were struggling a lot, and some of them didn't survive, but those who survived are again looking good, and they're growing earnings actually much faster than at the rate at which they're getting re-rated. So we have portfolio of companies in manufacturing related businesses, manufacturing aligned affiliated businesses where earnings growth is very strong and the valuations are still very, very attractive. So corporate banks, manufacturing allied, these are the businesses where we are finding opportunities.
Sure. And then one last question, if we were to assume that our markets were to really grow and capture a lot of the real economic growth will also come into the market, a lot of market cap creation has to come from IPOs. Now, the experience in the past 1 year, like you also pointed out, has not been very good. Mostly the venture capital companies and private equity pretty much squeeze out the last penny and leave almost nothing on the table for the public market investors. Now, how do you approach this space? Because from point to point, there is always, there are times of frenzy where IPOs, there might be very high demand, so it creates a short-term opportunity. And that might end up not too well over 6 months or 1 year. But you could also approach it differently, saying that this is a unique company, it's overpriced, but it might be a long-term compounder. How do you marry these two things, and how do you, what's your strategy for IPOs?
Indeed, this is a collective responsibility of one and foremost the promoters and the managements of the company, because this is not the last time they're going to raise capital. I think they need to give good experience to the investors, and to that extent, this is the first step in capital markets. It's a lot of responsibility on the part of both the promoters slash management. Second, obviously, the investment bankers, and lastly, us. So we've been on our side being very, very prudent all along. Every IPO that we evaluate with a lot of long-term investment horizon in mind. We actually analyze the businesses, what they can deliver in 5 years' time, in 10 years' time, what sort of cash. Most important is we asking the very difficult question to many of these businesses: what sort of cash flows you will generate, what sort of profits you will make. Because in the end, we are in the business where in the end there has to be cash flows to justify any valuations that exist for the shareholders today. So I think we are asking all the right questions. We are asking all the, maybe they're difficult, but they're the right questions to be asked to every businesses that are coming up. And we've been remaining prudent, and more everybody remains prudent. I think it's very healthy for the markets. And as you rightly said, this correction also makes it that much healthier. It brings both investment bankers and the promoters slash managements also to a level where they are talking of cash flows, profits, and then relative to the cash flows and profits, what valuations.
Sure. Thank you so much, Anand. It was wonderful talking to you as usual. Thank you.
Thank you. Thank you very much for having me.